Welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me is the CEO of Value Research, Dhirendra Kumar. Dhirendra, welcome.
Thank you.
You know, mid-cap and small cap funds are back in the news, Dhirendra. Investors have started to take notice of them. Do I see a revival happening here?
There could be, variety of things that happened in 2019. If you look at the taxation regime, it was made, it became concessional for small companies, mid-sized companies before the large cap companies. And in the last quarter, in September, we got the big announcement that corporate tax rates are down to 22%. So that, led to the surge of the large caps. Once again, there was a whole, repricing of the large cap stocks simply because they will be earning more. Even if they continue to do just as well as they were doing before. So, till 2019 or 2019 in particular was an outstanding year for large caps. One, the Sensex, Nifty, they were able to, do well. Howsoever narrow it be, howsoever the base be, the narrowness of the base, it doesn't matter. It did well. So, and at the same time, the previous years we had seen the resurgence of small caps and mid caps, and they were completely, small companies, mid-sized companies, they grow faster. They grow faster, and market went crazy by giving higher valuation. They started believing in the sustainability of the growth. For some companies it might be true, but for all companies it wasn't true. And then we saw the whole, back to reality, the cyclicality playing out, and people realizing. So we saw a wide array of, a big variance. There were outliers. There are small-sized companies, mid-sized companies which did not correct, but they were in minority. Most companies did fell, and did fell for a, right reason, in terms that, they had stopped growing the way they were. The other was that, they were also ran. There were a lot of companies which were primarily the story of, they were backed by a story only, not the reality.
Okay.
So the reality started catching up. So, we had a lot of dud small caps which fell by the wayside. We had, modest correction or maybe reasonable correction in the mainstream, and some companies which were able to, hold the ground. But despite all that, but that is the story of small caps. That's the story of mid-sized companies. When they grow, when they find their momentum, they grow faster. On a smaller base, the growth looks very impressive. But what we saw was that, the whole swing in the market's attitude to such companies, they fell, and they were unable to make a comeback. Large caps did very well on the other side. So, suddenly everybody is now realizing that there is a set of small caps and mid caps which are attractive. They are real. They're credible stories. They're worth banking on, and I think the interest is back. Early days, don't bank on it. Big companies, after this corporate tax regime, the big change in the corporate tax rate, I think, big companies, they have now been, the tailwind is on their side because they can get bigger. They have more money.
There's been a surge of 43%.
So in that sense, but I think that, if one is careful, it is always going to be a very narrow niche area of small caps and mid caps, and they are, because they are, 2018 end, we had the problem that what to buy and are they worth buying at this valuation? That may not be the case.
Okay.
So they are attractive again, and that is why we see the beginning of the interest.
Okay. As I said, the inflows in January have been somewhere around 43% vis-a-vis inflows in December. So does that mean this is now just the right time, perfect time to invest in these funds?
Oh no, timing it perfectly is a big folly, because it's very difficult to do that. The way an individual investor should look at it is that what is his allocation, how comfortable he is with. One should not forget, I think 2008 was a classic, it was a milestone in terms of experiencing the market. Large cap fell by 43%, small cap fell by 75%. And it's a grim reminder that you, in the worst case scenario, You have to be prepared for that. There are companies, and these are vulnerable companies. A smaller company, its ability to withstand a crisis is far lower than a company which will have resources to sustain itself, be through the difficult time, or navigate themselves, or wriggle themselves out of some crisis. That could be the end of a small-sized company. So we should not forget the reality. But at the same time, successful small cap companies which have been able to figure out something, whether it be a culture, product, innovation-led something, whatever they are doing, if they are able to grow at that faster pace, 40% growth, and it will find its taker. The charm of small cap is that the promise of turning into a mid-sized company or a large company. And we have all the large cap companies which were erstwhile small cap or mid caps. So whenever that happens, you build wealth, and that promise, the lure of that promise is very compelling. But I don't think investors should really fall into that trap of perfectly timing it. Have a meaningful allocation. Depending on your experience. It could well be 40-50%. If you understand, if you believe, and if you are not very uncomfortable with that 20% decline in 2019 or 2008 kind of situation, you are able to stick around, then by all means have a large allocation. But don't lose focus from why you invest and why diversification, because these times are very difficult. We have just too many things going on. And some of it is real, some of it is, some of it could be just made up, it doesn't matter. The fact is that, we have too many uncertainty. We have the dynamics of the market has changed. The kind of money that flows into the passives, which is primarily, the index fund, and the way, index funds are largely made up, or, they're designed in a manner that index funds finds, or a growth oriented company finds its a place there and actually gets larger with its weightage as its price rises. In that case, the foreigners actually investing in the MSCI index or the index fund, massive inflows getting directed not individually but in a bundled way. So these are going to be huge trends and very difficult to predict that. So don't lose focus on 2-3 things. One is that diversify, and diversification means 2-3 things across the segments of the market. Within that, emphasize your priority. Do you want to have large caps, or how much large cap you want to have, or how much small cap you want to have? Then making sure that you are not over engineering it, spreading your investments over time, because what is cheap now, or what is expensive right now, can remain expensive for a long time. We are finding that high quality companies, they were expensive and they are even more expensive now, and they're still finding takers, and they still dominate. They still have the potential to find way into the index and continue getting money. They may not correct for a long period of time. So the valuation bit in our whole framework of a high growth company, a reasonable quality company, and available at a reasonable price, that I think one has to forget for a while, because the dynamics is changing so rapidly. And we find that investors who are, or fund managers who are focused on value, they're really struggling.
Okay. So what I hear is that I should invest in it if I have a good risk appetite and I have time horizon.
Yeah. Of course, time horizon goes without saying. For equity, you need time horizon. Okay. But if you have the risk appetite, then be regular, and because these companies will actually remain very volatile. People will get very anxious, disappointed, and excited all at the same time, or all the time. That will be the context of the small cap. So you need to really overcome that, and that's not a very easy thing to do.
Okay, then who is suitable for investment in small and mid-sized funds? What are the parameters? Okay, let me put it this way.
I would say, I can actually articulate 2-3 things, which is mandatory for any small cap investor. One is that, first is who should not.
Right.
Which is, anybody who is getting attracted to the small caps just by looking at recent past performance should never. because that is what led to the whole disappointment, and you'll be disappointed again because you'll come with the expectation. So that's one. Don't look at last one.
Lalach buri bala.
Lalach buri bala, and and that is the investor's favorite pastime. You just see that, okay, can you ride this momentum? Here is the momentum, and it's clearly visible. So that should not be the starting point of your investment in small caps. Then comes, you should be investing with 5-7 years time frame in mind. Be regular, because and that will actually enhance your return as compared to making a one-time investment. What you are asking, that is it a great time to invest?
Yeah.
No, it's a good time to invest. And I think the third thing is that nobody should invest in small caps if you haven't experienced stock market or investing in market.
Or you haven't experienced the cycle.
The cycle. At least if you have been investing for 2-3 years, by all means invest in small caps independently.
Right.
Otherwise, don't invest.
Okay. Having said that, if someone meets all these criterion that you have just mentioned, how should one go about choosing a particular mutual fund scheme?
Same framework, credible fund managers. But one or two things which one should be more conscious of. Very large small cap fund, they have the headwind, odds are against them. In sense that, small cap company, the liquidity is low. If you have to build a diversified portfolio, then 2,000 crore and more, I think the fund manager will have a tough time managing it. Then comes, you should be investing for a full market cycle. Have 4-5 years time frame, definitely. If you are able to average your investment, by all means do that. And track record of the fund manager, because unlike all other funds being managed, if you follow a process and if you follow elimination criteria for companies which you will not invest, a fund manager can do well. In case of small cap, because the coverage is very low, not much is known about these companies. You have to really get into the skin of the promoters of the companies, the people who own it and the people who manage it, and sometimes they are the same people. Small companies. So you have to really see that, are they credible people? Will they steal money from the company? It requires far greater, intensity of management in terms of knowing your universe. And for every one company that you invest, you will have to evaluate 5 companies, maybe more. So in that sense, it is hard work. It requires, the fund manager with imagination, experience, and ability to validate those people. That I think is core of small cap investing. So look at the fund manager's experience, and I think that is crucial. If a fund manager has been around, not been around for 5 years and more, don't invest in that fund. Don't attach great value to those numbers, because the person who has delivered those numbers is not around.
Okay. And if you want to check all these things, you can do so on Value Research online. Okay. One has done all that. What's the best way to invest in them? Through SIP?
SIP only. Okay. Unless, you want to really take a punt, but that taking that big bet itself creates a lot of odds against in your own behavior. Because the moment assuming that you're going to do 30,000 rupees of SIP, and you have put in 5 lakh rupees of investment in a small cap fund to begin with, then you'll be so bothered about a 10% decline, 5% decline in the interim. What happens in SIP is that you feel pleased when they correct, when the prices fall, that you are able to buy cheap. So holding them through a full market cycle is the key to succeeding. And the moment you make a lump sum big investment, the odds are against an individual investor. There could be professional investors. There are investors who have the temperament. They are able to stick it through the different times, and they are able to stop themselves from investing. Maybe the valuation matters or whatever, or they are simply lucky. But that is not the kind of thing which an individual investor should attempt, and they never succeed at that.
Never ever lump sum.
Never ever lump sum.
Okay. So never ever lump sum. Make sure that you have the risk appetite in you, and you have the time horizon as well with you, and you're not a beginner. Right? And you're not a beginner.
You should be, you should have, because small caps is not meant for most investors can do without investing in small cap funds. Because when you invest in a multi-cap fund, there is an allocation. When you index, of course, the index funds, they don't have any small cap allocation, but most multi-caps, most value funds, most tax-saving funds will have their small cap allocation.
So it's time for us to get into the Q&A part of our program. And our first question has come from Pulkit Soni. He says, there was a news recently that SEBI is considering to alter the number of stocks in large and mid-cap universe. If this happens, fund houses might need few months to resettle the portfolio. So should I wait for that to happen to make any mutual fund scheme selection?
No.
No.
That's a brief answer, and I'll tell you why. And why I tell you, it doesn't matter. It doesn't matter much because it's not going to have a substantial change, a difference. One is that if you look at the large cap or mid cap or small cap definition as mandated by SEBI, is top 100 companies are large caps. Oh. Next 200 companies are mid caps, and rest of them are small caps. That's one. A large cap fund can invest, can also invest in not large caps. There is a leeway available, 10% or 20%. Likewise, mid caps. Likewise, small caps. Small cap funds are supposed to invest only 60% in small caps and rest in others. So they have ample flexibility in the first place. Besides that, even the current classification system has a provision that if you invested in a mid-cap company and it becomes large cap, you don't have to necessarily throw it out of your portfolio. You get time to calibrate your investment and stick around. You don't have to sell just to comply with that. It's not a very rigid system, and rightly so, because fund management, the valuation can change, stock prices can go up dramatically, stock prices can fall dramatically. A large cap companies can become a small cap company. We have seen them all the time. So in that sense, and whatever tweaking, whatever tinkering is going to be done by SEBI, it has come in the press, but I really wonder that how exactly it is going to be implemented, or what exactly is going to be the change. It is not going to be a very disruptive thing. It's going to be a very normal tweaking, and even the current funds have enough leeway whereby, and if you look at, you invest, these are the classifications meant for the pure categories, large, mid and small, which has ample leeway. Besides that, most of the money is into multi-cap fund, most of the money is into tax saving fund, most of it is in value fund or balance fund. So they have ample flexibility to be wherever. So I would say that most investors can do without worrying about this. If you have a plan, don't wait for don't make excuses. Invest
Continue
now.
to make selections.
Yeah, start your investment.
Okay. This one has come from, the next question has come from Ayodhya Nagar, and he says, how important it is to diversify among different fund houses? Can I not just stick to one fund house?
It is important. Once your money becomes meaningful, it is important to diversify across fund houses. But it depends on your scale. If you're going to start your investment with 5,000 rupee, maybe it's complex to have more fund houses. Just having one balanced fund provides you convenience. So choose a good one. But the moment your accumulation gets bigger, it is important to diversify, simply because even fund managers go in and out of favor. There is this great fund manager who has been doing well for many, many years, and then for 3-4 years he struggles. He has that is the case with most fund managers. The best fund managers go out of favor. The not so well-known fund managers, they come on the forefront. Things change, things churn. There is a churn there. So the moment your accumulation becomes meaningful and your real life goals are dependent on that, it is better to diversify, simply because you can't bank on the skill and the brilliance and the luck of one fund manager only. Okay. So that's the basic principle which one should follow.
So when they go out of favor means they choose wrong funds.
Yeah, they do. They find stocks, they invest in stocks, or, they build a portfolio which doesn't work as well as, so you will not be dependent on one person's mistake. Okay. And so that is the principle of diversification. That is why you diversify. That is why you invest in a mutual fund. And exactly for the same reason, you should have more than one fund manager's money, in money entrusted to more than one fund manager once your stakes are high. Okay.
Does Value Research Online give you this information as well?
Yes, in fact, if you go to Value Research Online's investment tracker, you get who is managing your money, and it is you also get a classification by way of the asset managers.
Okay. But a while back you mentioned that if somebody is managing a fund for 5 years or so, is a person that you can place
Generally,
your
yeah,
confidence
interest, yeah,
in.
yeah.
Okay.
No, I'm not saying that, because there is a possibility that a good fund manager may also do poorly at a time, on occasion. And that is when you get very nervous if you just have one fund company. So the problem is that can we stick to just one fund house? When that one fund house does poorly, all your money will be dependent on that. True. Which is not good.
Okay. What are the risks of investing in the exchange traded fund? This question has come from Ravi.
No, the first risk is, the market risk. Markets go up and down, and ETF will be exposed to that. But there is one specific risk which is only for ETF. When you see the ETF, the way to buy ETF is you buy like a stock in the market. And the ETFs are not very efficient many a times. You do not buy, we are used to buying mutual funds at NAV. When you invest in a mutual fund, you don't know what price you are getting, because you invest mutual fund for 10,000 rupees or 50,000 rupees or 5 lakh rupees or 1 crore rupee, whatever. You give it before 2:30 cut-off time, and depending on what that day's price was is what you get your mutual funds on. When you buy ETF, you put an order that I want to buy 100 units of this ETF. It could be far higher or lower, small, little higher or lower than the NAV, because it depends on the demand and supply as well. So one is looking at the premium and discount to the NAV in the market price. That is one. And that's about it. Otherwise, all the risks are as much as the underlying index on which it is mounted on.
Okay. Shiva Verma has written to us saying that I had started an SIP in a thematic pharma fund around 2 years back. The gain now is barely rupees 200. What should I do?
If you are a long-term believer in pharma, then carry on. At least you are not in losses. And this was perhaps, I don't know whether the worst is over. And it's very difficult to say, because there's very dramatic changes happening in the pharma industries, or the dynamics are changing completely. Some companies are wriggling it themselves, are somehow able to get themselves out of the crisis of the FDA investigations and other things. At the same time, I don't know when what we have seen, before these 2-3 years of the struggle of the pharma industry, pharma index was one thing which, pharma category, which always did well. 10-year return was actually stacking up as a number which was very compelling. People started believing that value research keeps saying that sector funds are not good. What do I have to say? It was quite embarrassing to be saying that, pharma is an outlier, or it has violated the principle that we have believed in. And then after 10-11 years, we see this big decline. I'm not very proud of it. But what I'm saying is that this is a concentrated bet. Pharma has been through a very difficult time. And I don't know if you succeed. Pharma is something essential. It is non-cyclical. And if the industry is able to settle with the dynamics of it, maybe, a couple of years, it should be rewarding. But generally, my reason why I say that why you should not invest in a sector fund is that you are giving a limited mandate to the fund manager. If you invest in a diversified equity fund, the fund manager will decide when to have pharma, when not to have pharma altogether, when to have little of pharma, or when to have a lot of pharma stocks in their portfolio. And when you invest in a pharma fund, you say that invest all my money in pharma stocks only. So whether good or bad, you have to live with it. So you are violating the principle of diversification.
So what should he do? Get out of it, or?
It depends. Barely rupees 200, so I don't know what is his total investment. But if pharma is going to be 10% of his investment and he believes in that, he should carry on. Otherwise, don't over-engineer. Diversify, 2-3 multi-caps, end of the story.
Amarnath Trivedi has written in this question, and he says, I have a lump sum amount to invest, which would be required by him in 6 months to 1 year time. What kind of debt fund should I invest in?
I think he has very limited option, and I think he should not venture anything beyond that. Even debt has, become volatile or, disappointing for many. One is that just be limited to ultra short-term bond fund. That's about it. It will give you a little more return with great flexibility of, with good liquidity if you invest in them. And while choosing debt fund, I think one simple principle to follow is that don't invest in the best performing ones, because the best performing ones, they will be assuming risk which you will not be prepared for.
Bhaskar Paul says that I have a lump sum of 20 lakhs of rupees with me and I want to invest them in mutual funds. And I also want to have a systematic withdrawal plan of rupees 20,000 per quarter after 2 years. So where should I invest? Which fund? Large, mid-cap, small cap, multi-cap? Please advise.
20,000 rupees per quarter, which is 80,000 rupees a year, and that to 2 years from now. So it's not a very aggressive expectation. I think, Bhaskar Paul should invest something like 80,000 rupee in a debt fund and spread the 1 lakh, 19 lakh 20,000 rupee over the next 2 years, so that all his money gets invested and becomes, a lot of money will be. So he should divide his 19 lakh 20,000 rupee by 24 and start doing an SIP. Move the money into a balanced fund. And first 80,000 rupee which he has retained in the debt fund, that he should use in the first year. And third year onward, I think, he should do a systematic withdrawal plan of 20,000 rupees a quarter. I think he will also have the luxury of revising his 20,000 rupee to higher amount, because that by then the money would have withdrawn. So, 4% of the increased amount he can actually do a SWP from there on, from the third year.
Okay.
So there's a simple plan to implement.
Okay, Bhaskar, I hope you made a note of what Dhirendra has advised you. We have a question from Mahendra Yadav, and he says, which fund is better among arbitrage and short-term debt for regular income? I'm in 25% tax bracket according to the new tax structure.
25% tax bracket. So it depends, for regular income, these funds actually become very attractive if your holding becomes more than 3 years old. And if it is just for 1 year, then arbitrage fund is more attractive, because 1 year holding period, 10% long-term capital gains. So that makes it attractive, because arbitrage funds are treated as equity funds from a taxation point of view.
Okay.
So make a bulk of your investment in short-term debt fund, from which you will not start withdrawing in the initial years. And the money which you need in 1 year's time, I think that is something, or maybe a mix of this, limited amount in arbitrage, dominant amount in short-term debt fund, a good part held over 3 years, then it will become very efficient, because after indexation, the tax incidence will be far lower on your regular income.
Dhirendra, thank you so much for answering the queries of our viewers. Thank you, all of you, for tuning in. And till we meet next time, please continue to invest wisely.